Welcome back to Commodity Champions. And David, coming to you now, there is an expectation that the steel tariff will hurt oil and gas industry also. Of course, changes like tax reforms mean that the business environment might stay positive. What is your own sense now, and how much would you look at the crude oil fundamentals in itself, and how would the steel tariffs actually impact or really impact the ground level?
Look, certainly the oil fundamentals will play a key role in continuing to drive the prices, and that is we do expect to see greater demand coming out of the US this summer as we move into their drive season. So that's going to put pressure, we think, on the positive side for the oil price. Yes, domestic production inside the US is rising, but we do expect to see demand inside the US moving at a quicker pace as we start to move into the summertime. So that's going to, we think, drive the prices. As for the steel, yes, it is used inside the oil industry, primarily when it comes to certainly new developments and new fields. In terms of the existing operations, most of them can survive without too much input from the steel sector. So we would expect it's only those new wells that would be coming on stream post the tariff implementation that will hit somewhat higher costs for development. So otherwise, we think for the oil sector and for the most of the companies, life's just going to go on as usual.
Okay. Jonathan, what is your sense on the crude oil prices? Because apart from what we are seeing in the global markets, the macro, that is, the US industrial output, or rather the crude output, has been increasing to record highs as well. Do you see that adding pressure to the prices going forward?
Well, I don't. I can see that we've got the leverages, the supply and demand leverages. You know, when I see the US pushing more oil into the market, I also see it continuing to drop off from Venezuela. We've still got a few issues there in terms of pipelines in Libya. But when you look at the whole equation, I think for global growth, we just need to see the price of crude remain in a range. So I'm more adopting more of a range trading style of attitude. And my lowest end of the range forward would be about that $57 on the WTI, and the top side obviously around about that 63 level. So I think I'd love to see oil in that range where I can take advantage of just range trading opportunities.
Jonathan, one would have believed that with so much uncertainty in the global markets on what we have seen in sense of currency, the equity market sell-off, the US tariff import, etc., and the weakness in US dollar, you would expect the gold to attract some money. That clearly hasn't happened.
Clearly, there's no doubt about it. I think the markets just basically just decided not to focus on it. I think when you look at the way gold is behaving, from a fundamental and technical view, it's just holding ground. Yes, we've been under a little bit of pressure, but nothing too major. And I think when I do look at it from a technical background, it is actually still quite supportive. You know, and I actually think those dips still look quite reasonable. I just think it's really investors have lost, or they're moving to other investments. You know, so I think gold's lost its shine a little bit, but perhaps that's the time when you should be looking at it, when the market's not focusing on it.
Well, yes. David, many people have been bullish on silver prices, but it refuses to budge beyond that $17 mark. And as Jonathan is pointing out, gold has been a surprise. It hasn't budged on the higher side. But are you looking at these current levels as a good buying opportunity?
Certainly the one big surprise has been gold. One would have thought with the turmoil that we've seen with the announcement of the tariffs in the US and the trade wars that could emanate from that action, one would have thought that safe haven investments such as gold would have been where investors were looking. That doesn't appear to have been the case. We are aware that over the course of February there were significant sell downs of gold out of the ETF funds, which has placed some pressure on the gold price. So that's likely to continue for the short term and put further pressure on the gold price. However, again, it's really going to be the outcomes that we see from the final tariff lists in terms of who's on it and who's off it and who's going to retaliate and who isn't, that really will, we think, determine just how much safe haven investors will be seeking, and they'll then start to move towards gold. Silver, it's really dependent now, we think, on the synchronisation of global growth, and with that, the increased activity in the industrial sector. That particular as silver has a big content of use in the industrial sector, if we continue to see the sector growing, then that's going to bode well for the silver price.
So we still are waiting on that safe haven money to come into the precious metal prices. But David, while you said that it has been a surprise, Jonathan, what is your sense on gold and prices, silver prices going forward from here? Are you working any numbers? Are you still sticking to your projections that we perhaps could be looking at a bullish year in 2018?
It's certainly likely on the gold market. I'd like to see, obviously, around our current levels actually hold, but at the end of the day, I'm still looking for about a 15%, 15 through to 20% rise towards the later half of the year. I still feel that we've had issues in terms of the fundamentals and the technicals, but the market's decided not to focus. But I think they will as the year progresses, and that's why I'm looking for those returns.
All right, so a possibility that the 15% gains in the gold prices could still really come, as we are looking at a lot of uncertainty in the global markets there, whether it is equities, global trade wars, or of course the currency play. But that really brings me to my next question, Jonathan. How would you look at the currency play impacting all of this? Because we already are in the month of March. There is more than 90% probability of a US rate hike in this month. How are you looking at the rates going forward? How do you see that impacting commodities? Because not just US, in this week, we've had monetary policy meetings from ECB, from Canada, from Japan, and from Australia as well.
Well, I guess obviously when we do look at the metals, obviously whatever the US dollar does will affect that. We look for other outside influences, obviously, to help dictate more of a range for the metals. But when I look at the US dollar, generally rates moving higher. People are saying that it should be positive US dollars go up. But I'm more inclined to want to think that, this cycle is changing. Therefore, we'll get disinvestment out of the US, and then it'll move to other parts of the economies. So as a result of that, I'm more of a bearish, have more of a bearish outlook on the US dollar, which also goes to help support my positive commodity outlook. So I think that people that are invested in the US will say, okay, the cycle's about to change. We're going to start to move our money away from there and sort of either bring it home or to other outside investments.
All right. So just to summarize on what both our guests are telling us today is that they still feel uncertainty to prevail when it comes to the metal space. Crude oil prices are expected to trade range bound. It is a buying opportunity perhaps in the precious metal space where gold and silver are up for takes. And it definitely does look like a bearish year for the US dollar going forward. So that perhaps actually could turn around as a big positive when it comes to commodities and other asset classes. Well, thank you, gentlemen, so much for joining us and giving us your sense on what really can be expected from the international markets for the next week. But with that, it's a wrap up on this edition of Commodity Champions. Thank you for watching.